I posted this. Oh, I need to share my screen. It is a lot, but like this is like the most important things for every chapter. So I will like study this and memorize like, yeah, all these formulas and concepts. So I don't know if you guys want to like do this review really quick and then do like the questions, or if we should just do the questions and then while we do the questions we review it.
My 2 cents is let's review first and then do the questions, but let's see what everybody else has to say.
I agree.
Okay, sounds good. So chapter 1 was they taught us about direct cost, indirect cost, and that manufacturing cost has 3 different costs: direct materials, labor, manufacturing overhead. The prime cost, remember that is these 2, direct labor and direct materials. And conversion costs are direct labor and manufacturing overhead. Then there are also product costs and period costs. So product costs are the same as manufacturing costs. So these 3. And the period costs are the other costs that are non-manufacturing, like selling and administrative expenses. Okay, for chapter 2, remember that there are basically like 3 manufacturing overheads. So there's the estimated, and we use the estimated only to find the predetermined overhead rate. And the predetermined overhead rate is the estimated manufacturing overhead divided by the estimated allocation base. So it's whatever they're basing manufacturing overhead. So it can be, it's usually like direct labor hours, can be machine hours, or direct labor costs. So that's the allocation base. This one is also called, we can call it Y, and this is X. Okay. And then for the applied manufacturing overhead, do you guys remember how to do it?
Actual over actual actual machine hours, or the actual manufacturing overhead costs over the actual allocation base.
It's almost is the actual allocation base
Over the what you've come to as your rate.
Yeah, that's
whatever you're calling it.
Close. So you don't divide, you multiply it times
Multiply it. Yeah.
Determine overhead rate.
It's like, I know how to do it. I'm just struggling to put it into words.
Yeah, it's okay. Yeah, so like this estimated manufacturing overhead, the only thing that you use it for is to find the predetermined overhead rate. That's it. The ones that you're going to use in like calculations is, or like in the T accounts, is the applied and the actual manufacturing overhead. And then with the actual, you don't calculate it, they just give it to you and you have to see the difference of these 2. But yeah, and remember that the applied is you multiply times the actual hours or actual allocation base, not the actual manufacturing overhead. This estimated manufacturing overhead, I said that this is Y because you can do like an estimated, or like any mixed cost uses the Y equals A plus BX. And that's why X is the allocation base. Okay, then we move to to the T accounts. So remember that all the T accounts can have a beginning inventory, and then right here is gonna be the ending. Everything in the credit is what goes to the debit to the next one, and they all follow an order. So it's always raw materials, work in process, finished goods, and cost of goods sold. And direct materials go into work in process, indirect materials go into the manufacturing overhead. And this green manufacturing overhead is the applied manufacturing overhead, not the actual or the estimated, just the applied. And what you create, or all the goods that are manufactured, that's cost of goods manufactured, and they go to finished goods. And then what you have, like the inventory of goods, finished goods that you already had, and cost of goods manufactured that you created in that period, if you add those together, that's the cost of goods available for sale. 1 second. One second.
I feel like understanding this and applying this is where I struggle. Like reading a question and knowing what to do with that information in regards to all of these T accounts is where I struggle.
I agree 100%. I almost just need to like go through the questions to see, like, I do better with the questions to the application than the application to the questions, I guess.
I need to remember that. I don't. I need to review it.
Seems like an excessive amount of information to try to memorize for a test.
Yeah.
Well, and I think that this one particularly was so beefy. Like there was so much to try, and where does everything go?
Yeah.
The concept of this doesn't make sense to me. Like I can see and I can probably even memorize and write this out, but I don't even know that the concept of the T accounts really resonate with me.
Well, and in the review from Brother Prater, he said there's 4 questions with this
Yeah.
one. So you needed to understand this. And I'm
Yeah.
like, shoot, how?
Again, I would rather just see the questions, like just show me what these questions look like. I was kind of sad with his review a little bit because I just want to go over questions and be like, okay, that's what this question could even look like, you know?
I'm planning to review the quizzes
Yeah,
because they will help a lot.
I think that's going to be the best bet.
Yep.
Okay. Sorry guys, that was a really important call.
That's all right. Life
So, like,
happens.
You
do you
did it.
guys have questions about the T accounts?
I think we were wondering what questions look like, like this, what, can you remind us what the question looks like where we need to and how we need to apply this to the question?
I
Yeah.
think there are some in your review, right? That we're gonna
Yeah,
get to.
we're gonna
Okay.
do
Okay.
one. So it's like, they usually gives you the sales. Oh no. Wait, I need to remember, what is it? No, we'll have to see it because I don't remember. I got confused with chapter with this one, but it's different. With this one, I think the thing that I would ask the most is if it's under applied or over applied. So you have to like find the applied manufacturing overhead and the actual goes in the left side of the T account of manufacturing overhead, the applied in the right. And then you have to like adjust cost of goods sold depending on the difference of actual and applied. So remember that if the applied is less than the actual, then it's under applied, like you under budgeted. And if it's more, it's over applied. So if it's under, you have to add it to an adjusted cost of goods sold. If it's over applied, you subtract it. Yeah, I think that would be like the main questions that I would ask, mostly with actual and applied manufacturing overhead.
Now, Natalia, did you say this document that we're going over, are you going to be able to share this with
Yeah, it's
us?
already shared.
Okay, perfect.
Okay, so this is what I just explained. For chapter 6, we go back to y equals a plus bx. So they will give you like a table of like units and cost, or maybe they will only give you 2. And you just have to find B, which is the variable. So you use this formula to find the variable first. So like B is the variable, so it would be y2 minus y1. So the difference of the cost of the 2 costs, like the high one and the low one, divided by x2 minus x1. And then once you find that, you have B. If they ask you for the fixed cost, so the A, then you would just do this formula, y equals a plus bx, using y as one of these, like let's say y1, B, what you just found, and x will be the x1. Remember to use, like, if you're gonna use the high one, use the units of the high one, because if you mix them, then it's gonna be wrong. Or you can use the low one too. All right, the contribution margin ratio, you get the sales divided by the, the contribution margin divided by the sales, and it can be the total or per unit. And you do the same with variable expenses, but I don't really think they're gonna ask for the variable expense ratio. The contribution margin ratio is more important, but it's the same way, it's the variable divided by sales. And if you add these two together, it will give you 100% because sales is 100%. Then the break-even point in sales is the fixed expenses divided by the contribution margin per unit. But if they ask for the dollar sales, then is the contribution margin ratio instead of the contribution margin per unit. The target profit is basically the same as the break-even point formula. It's just that you add target profit. So unit sales to attain target profit is the target profit plus fixed expenses divided by unit CM. And the sales is the target profit plus the fixed expenses divided by contribution margin ratio. The margin of safety, remember that is the, like if we have profit and cost, and this is the break-even point, the margin of safety is how far you are from the break-even point. So you do the total budgeted sales minus the break-even sales. So this one. And if they ask for a percentage, is the margin of safety in dollars divided by the total budgeted or the total sales. The degree of operating leverage is how much, if sales changes, how much is gonna change in net operating income. So is the contribution margin ratio, contribution margin, and then divided by the net operating income. And that in percentage is the degree of operating leverage times the percentage change in sales. So like if sales is gonna change 50%, you just multiply that times 2 if that's the degree of operating leverage. Okay,
Did we learn this stuff? Did anybody else remember this? Because I remember it, but I don't remember learning it.
I
And I
remember
don't know
studying it
how
for
to-
a test, but it's not there anymore.
yeah, that was, let's see, that was week 2, 3.
And I
Oh,
don't know
it
how
was
I'm gonna
like
remember
six.
all of these formulas.
Yeah, it was for exam 2, so it was a while ago.
Yeah, because I had to pull this out so I could put other stuff in that space since then.
I'm
That's
with
my
you, Katie,
problem
that
is
was
trying
me.
to remember them all.
Yeah, same.
Yeah. Okay. This is the last chapter for exam 2. Do you remember the decisions, the discontinue a product, make or buy, and a special order?
I almost wish that they had taught this course in reverse because the stuff at the end made so much more sense to me than the stuff at the beginning. And so I'm like, these later units were so much easier to grasp. And so I'm like, if they had done it in reverse, these ones would have been easier. I'm like, and we have the ratios, we're able to use like, so I'm like, these are still in our mind, they're fresh, but they give us everything. So I'm all, we don't need to have this reviewed and fresh in our brains. They could have taught this at the beginning, unit 4.
Yeah.
Taught
But
us
maybe you
unit 1.
understand more the last chapters because you already saw these first ones. I think what they should have done is do the high-low method right after the manufacturing overheads, because that would have made more sense. But oh well. Okay, so the chapter 11. So when you want to see if you should discontinue a product or not, or a segment, you get the fixed expenses that can be avoided. So like all the relevant fixed expenses. So remember that when it says allocated, it means that it's a cost that is for the whole company, but they just divided it into segments. So that one is not relevant because you still have to pay it for the company, even if you discontinue the segment. So always look at the relevant cost and then you subtract the contribution margin of that segment. If it's a positive number, it's an advantage, or if it's a negative, then it's a disadvantage and you shouldn't discontinue the product or the segment. Then the make or buy decision, you get like how much it will cost to make, or sorry, to buy that product, and then you calculate all the cost to make it. So again, you just find the relevant cost, not the irrelevant, like the manufacturing overhead, like the fixed cost that you will have to pay anyway. And then you subtract those two to see which one is more expensive, and if it's better to buy it or to make it. And then the special order is pretty similar to the make or buy decision, because you first calculate how much revenue you're going to get with the special order. So like if they want to buy a necklace for $15 each and they want an order of $100 necklaces, then you just like multiply it to see how much revenue is gonna give you. And then you just, again, you find all the relevant costs to see if it's gonna be less than $15 per unit. If it's more, then you shouldn't do the special order. So you subtract the step 1 and step 2. And the constrained resource, remember that is the contribution margin per unit divided by the time that required to make 1 unit. So if they give you like sales or like the price of that product and the variable cost and then the minutes, you find the contribution margin first. So you subtract sales and variable expense and then you divide that contribution margin divided by the time or the minutes. And they will give you like different products with different contribution margins and different minutes. And you just need to do like rank them from 1 to 3, 1 being the highest number, because that's the one that gives the most contribution margin per minute. And every time that they ask like how much are they willing to pay for this product or whatever, it's always the lowest one with the contribution margin divided by the minutes. Always the lowest. And we're gonna do a question like that one. Okay, then chapter 8. I will go through that master budget again and review it because it's been a while and it's so much information. But remember this order, that is always the sales budget, and then it goes to the production, and production has 3 budgets. It has a selling and administrative expense from sales. These 3 plus the sales plus the selling makes the cash budget, and the cash budget with the sales makes the budgeted income statement. Oh, and with selling and administrative, and then the budgeted balance sheet. But I think that for the final, they would ask you especially for these 3, I feel like. Especially direct materials budget. So with direct materials budget, remember that you get the sales units from the sales budget, and then you multiply like the kilograms or whatever unit they're using for the direct materials, and then you add the ending or desired ending inventory that they want, and then you subtract the beginning inventory. And it's always the same for all the budgets, is you add the ending and then you subtract the beginning. And then at the end, if you need it, you can multiply times the price to see how much it's gonna cost to buy those direct materials.
Do you think that we'll have to build the whole budget, or just kind of what you just outlined, like take the sales units, multiply it by what they gave us for the direct materials, and then get the ending, add our ending inventory, subtract our beginning? Like,
Yeah, sometimes you don't really have to build the whole budget. And there's a question that we're gonna go that you don't really have to do it, but if that's the best way that it makes sense to you, then I would totally do the whole budget. For only like the month that is needed, not all of them, because that will take a long time. So chapter 9, we have, remember that we have this for direct materials, direct labor, and manufacturing overhead. And remember to do it in 3 columns. So the direct materials is actual quantity of material times actual price. And then the third one is standard quantity times standard price. And then the second one is actual quantity times standard price. But for direct materials, remember that if they bought direct materials but they didn't use all of them, then there's gonna be like 2 columns right here, with this one being what they purchased, and this is what they used. And then for direct labor, for direct labor, instead of quantity and price, is hours and rate. So actual hours standard rate, standard hours, and standard rate. And the same for manufacturing overhead, because usually manufacturing overhead is based on direct labor hours. So same actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. And then all of these are the spending variances. This one, do you guys remember what it's called?
Labor variance.
What was that?
Isn't it the labor variance?
Yeah. Actually, this is the rate variance because
Rate variance.
yeah, we're comparing actual rate and standard rate, so rate variance. And then this one is the labor or efficiency variance because we're comparing the hours. And the same here for manufacturing overhead. For this one, it would be, or like this purchase would be the price variance. And this one is the quantity variance. And it makes sense because what you purchase, so it's a price variance, and then what you used, quantity variance.
And to find the standard quantity, we take what is allowed and multiply it by the actual output, right? When we're looking for on the direct materials,
yeah.
when we're looking for the standard quantity and the standard hours.
Yeah,
I just want
for
to make
these-
sure I remember how to get those.
Yeah, it's awesome because they will give you maybe like a standard quantity, but only for one product. And what we want is to do the standard quantity for all the actual output. So standard quantity per unit times the actual output. And the actual output is how many units they made for that period.
So sorry, on the quiz or on the exam for this one, they were pretty clear about asking for the price variance, the quantity variance, the rate variance, and the efficiency variance. We didn't really have to do a lot of like doing it backwards. Does that make sense? Do you
Yeah.
think with the final that it's going to be pretty straightforward like it was with the exam? Or do you think it's going to be more? Because I know that we did one or two in the homework where we had to go backwards to do it. But
Yeah,
I
in
don't
the
remember how
application
to do
form,
any
but-
of that. Yeah.
Yeah, it's not gonna be like that. The exam questions are pretty much straightforward. They don't ask you to go backwards.
Okay, thanks.
All
And
right.
how many questions are for the exam?
I don't know. Have your instructors told you already? Because I think some of them
No.
do.
Okay. I'm gonna check again.
It's 320 points. But
Maybe like
do you
50
think they're,
questions.
oh man,
Yeah, I would say like something around 50, but I don't remember.
do you think, so you know in our other exams how they have like some that are worth 20 points where you're doing more? Should we expect something like that? Where we're doing more and or is it all multiple choice?
It's mostly multiple choice, except for the ratios again.
So I have a friend who already took the final exam and she said that it was only one fill in the blank question. It was ratios, everything else was multiple choice.
That's good.
Thank you.
Thank you.
Okay, so
So we
for
don't
chapter
have that
12, well, I think this is pretty fresh. So same thing, remember that the present value of cash flows, you use this formula in Excel with the rate and the total cash flows from year 1 to whatever year it is. And then for the net present value for the project, you see the difference, or if this one is in negative, you do the sum of the total cash flow of the investment and the present value of cash flows. The simple rate of return is the annual net operating income divided by the initial investment. The payback is the initial investment divided by the annual cash inflows, and project profitability index is the present value of cash flows divided by initial investment. So remember that all of these have initial investment in them. And then remember that to find, if you get cash flows but you need net operating income, you subtract depreciation. Or if you need the cash flow from net operating income, you add it back. And then depreciation is the investment minus the salvage value of the same machine or the same investment, if they give you one, divided by the useful life in years. And the initial investment, so like for these 3 formulas, if they give you the salvage value of an old machine that they're going to sell and then buy a new one, then you add that salvage value to your investment. Or well, like basically you subtract it because the initial investment is cash outflow, so it's in negative, and then the salvage value is in positive. And then chapter 14, just like using the ratios, and make sure again that if the numbers that they're giving you are in thousands or if not, and yeah. So let's see the questions.
So for those that were asking about the exam, I just looked up on a sheet that my professor provided, and it's been right sometimes, but I know they kind of make adjustments each semester. What she said is that it's 32 questions long, but sometimes it's been off by a question or two.
Yeah.
So about 32 questions. So just for information.
Yeah.
Thank you.
Yeah, that's better than 50. Okay. So let's see this one. Most recent year, the company based its predetermined overhead rate on total estimated overhead of 61,400 and 2,000 estimated direct labor hours. The actual manufacturing overhead for the year amounted to 63,350 and actual direct labor hours were 1,850. So what is the applied manufacturing overhead for the year? So what is the formula again for the applied? Because that's what they're asking.
Actual allocation
Yeah,
rate times rate.
times predetermined overhead rate. Yeah, perfect. So we have the actual allocation base because they give you the actual manufacturing overhead and the actual hours. So it's 1,850. But we don't have the predetermined overhead rate yet. So how can we find that?
So we need to divide the
Manufacturing overhead.
61,400
Yeah.
by the 2,000 estimated hours.
Yeah, so estimated manufacturing overhead divided by the estimated allocation base, 2,000. Perfect. So now we just have to multiply 1,850 times the 3,050. So the applied is 56,795. Okay. Let me know if you have questions. Would this be under applied or over applied?
Is it under?
Would it be-
Yeah, it's under.
Yeah,
Why?
because they actually spent 63,350.
Yeah, so it was more than what they budgeted. Yeah, good job. Okay. A soft drink bottler incurred the following factory utility costs: $35.61 for 800 cases bottled and $3,658 for 1,200 cases bottled. Factory utility cost is a mixed cost containing both fixed and variable components. The variable factory utility cost per case bottle is closest to. What do you think we have to use for this one? Or what formula?
The Y or the A plus B, whatever. We have to find the,
Huh?
right?
Yeah, the high-low.
Yeah, the high-low method.
Yeah, every time they give you at least two
Yeah.
total mixed cost with units, then high-low method. So we can do the Y's and the X. So the cost, actually let's do it. So the units and the cost. And the first one is 800 and it's 3,561. And the second one is 1,200 cases and 3,658. So yeah, so the formula is Y equals A plus BX. And but with the high-low method, which one are we going to find first?
B.
Yeah. So with the, remember with the high-low method, we find the variable first. So the variable will be the difference of the Y's, my goodness, divided by the difference of the X. So this is Y2 minus Y1, and then we're gonna divide it by X2 minus X1. And then that is 0.24 cents.
I'm sorry. You said you, for the number 97, what did you do?
The 97, what do you say?
What did you do? I missed that one. How'd you calculate that?
So remember that is Y2 minus Y1 divided by X2 minus X1. So this is, we're saying that this is Y2 and Y1. So we're just subtracting these two to get 97. And then we subtract these two to get the 400. Does it make sense?
The 97 is the higher cost. So it's the higher price minus the lower price.
Mm-hmm.
And then the higher units minus the lower units.
Yeah. And once we divide those two, we get the variable.
So if it were the other way around, I guess it wouldn't be. The high is always gonna be the higher. It doesn't matter which one you do, you're just always gonna put the high minus the low, right?
Yeah, because we don't want to have negative numbers here.
Okay.
And they could even, like, there'll be instances where they'll give you like 8 months worth, and you have to find the one that's the highest and the one that's the lowest,
Yeah.
and subtract the lowest from the highest.
Yeah. Yeah, it will be either a question like this when they give you the high and the low already, or you can find it in the table.
Mhm.
So now if we have the variable, we could find A, the fixed, but like for this question, they're asking for the variable cost. So that would be it. But if we want, or if they're asking for the fixed cost, then we will do this formula, and we're going to change the Y by one of these Y's, no matter if it's the high or the low. So let's do, I like to do the low because it might be easier. 3561 equals A, because we don't know, plus B that we found, 0.24, times X. And if we use this one, we'll have to use the same X. So 800. Okay, so now we can multiply that. Let's see, 24 cents times 800, 192.
And what is that one finding?
We're trying to find A, the fixed cost.
Okay,
Okay, so 3,561. And now we can subtract 192 in both sides. To find A. So 3,369. Okay, so like that, we know that this is the fixed cost, the total fixed cost, and this is the variable per unit using this formula. Okay. So question 3, during the month of April, direct labor cost total 14,985 and direct labor cost was 45% of prime cost. If total manufacturing costs during April were 75,000, the manufacturing overhead was, this one is, we're going to use what we first saw. So prime cost is direct labor and direct materials. So they're giving you direct labor and they're saying that direct labor is 45% of prime cost. So that means that the other, what is it, 55%? Oops. Yeah, 55% is direct materials, but they're asking for manufacturing overhead. So direct labor is 14,985. The prime cost is direct labor and direct materials. There's a total of manufacturing costs that they also give is 75,000. So that means direct materials, direct labor, and manufacturing overhead total is 75,000. Oh, and this one is 45% of prime cost, but they're asking for manufacturing overhead. So this one is mostly like algebra. So we first need to find the total of prime cost. So let's say that prime cost is P. So 100% of prime is 55% direct materials. So let's do 0.55 prime, because the 55% of prime, plus 45% of direct labor, but we already have this number, so we can just use the 14,985. And then we can subtract this 0.55 prime in both sides. So 1 minus 0.55 is 0.45 equals 14,985. And now if we divide this 0.45 in both sides, we will get the total of prime cost. So 14,985 divided by 0.45 is 33,300. So you can try to remember this formula, or you could simply divide these two, 14,985 divided by 0.45%, and it will give you a total of prime cost. So now that we have the prime cost, we're going to find direct materials. If direct materials is the 55%, you just get the 55% from the 33,300. So 18,315. And now, what do we have to do to find manufacturing overhead? We have direct materials and direct labor.
You just subtract it from the total.
Yeah. So we do the 75,000 of manufacturing total cost minus direct materials and minus direct labor. And that's the answer. So 41,700. Questions about this one? Because I know that it can be hard because it's mostly like algebra more than managerial accounting. Okay. Now for question 4. So they give you this net income statement based on 6,200 units. And then they're asking what is the net operating income for 6,400 units. So what do we have to do for this one?
Get your price per unit first.
Yeah. And the price per unit is the total of these cells, 217,000, divided by the 6,200 units. So 35. And now, because they're asking for 6,400 units, we just have to multiply this 35 times the 6,400 units.
Wouldn't you also find the variable expenses by unit as well?
Yeah.
I'm sorry, I think I missed something. The 35, well, how did you get that?
So you do this total 17,000 divided by the units.
Okay,
And we're gonna do the same thing with variables. So 117,800 divided by 6,200 units, 19. Now we multiply $19 per unit times the new unit, 6,400. Okay. And there are different ways to use. If you want to do it even faster, you can find the contribution margin ratio and then do it based on that, but let's do it like this. So sales minus variable, contribution margin, and then the
Fixed cost
fixed.
stays the same.
What was that?
Fixed would stay the same because it's fixed.
Yeah. And then we just subtract these two. And this is the answer. Okay. Let's see, both corporations' fixed monthly expenses are 26,500 and its contribution margin ratio is 61%. Assuming that the fixed monthly expenses do not change, what is the best estimate of the company's net operating income in a month when sales are 85,000? It's a little bit similar than the last question. Okay. So how do you guys solve this?
Well, your contribution margin ratio is CM divided by sales.
Mm-hmm.
So you could take your 61%. Well, your 85,000 and divide it by your 61%. And that will give you 51,850. And then you can divide that by your fixed monthly expenses to get your net operating income.
Sorry, so you say you divide it by the contribution margin ratio, or you multiply it?
I multiplied. Sorry.
Oh,
I multiplied
yeah.
it. I said I
Yeah.
divided, but I multiplied it, and then you subtract your fixed expenses.
Yeah, that's perfect, because the contribution margin is simply the contribution margin ratio times the sales. So the 85,000, which is the sales, times the 61%. This is the new contribution margin. And then because fixed expenses don't change, then we just subtract them to get the net operating income. 25,350. Income, this is fixed expense, and this is the contribution margin. Now, question 6. Also, this is the constrained resource. So what I was telling you, they could give you like 3 products and not give you a contribution margin, but you have to find it. And they're asking up to how much should the company be willing to pay to acquire more of the constrained resource. So we can do like all the products. Thank you. And then let's find the contribution margin per unit. So it's the selling price minus the variable cost. So 335 minus 259.62. And then we just do that for all the other products. And then they give you the minutes too. Okay, so what do we have to do now?
Don't we divide the contribution margin by the minutes?
Yeah. Good job. Yeah, because we don't use only the contribution margin. We need to see like how much contribution margin they give per minute. So we divide it. Okay. So if we're ranking them, this will be number 1 because it gives the most, the number 2, number 3. But they're asking how much should the company be willing to pay to acquire more of the constrained resource? So which one is it?
1056.
Yeah, because it's always the lowest one. Also, if they ask like how much would they be willing to, like what would be the minimum price? All those questions, it's always the lowest one. Okay. So for this one, this is the budgets. So this is the sales budget with the units. This every unit needs 1.5 kilograms of this material. And the company wants to maintain monthly ending inventories of 30% of the following month. On July 31st, the requirement was not met since only 10,400 kilograms of Jerusalem were on hand. The cost of Jerusalem is $4 per kilogram. So they're asking for the desired ending inventory of Jerusalem. So if they're asking for this material, that means we need to use direct materials budget. So, and they're asking for September, so we don't really have to do all the months. We can do like 1 month before and 1 month after. So let's do August, September. So we first start with the sales units. And then what do we do now?
When you take the units times the kilograms of raw
Mhm.
material,
Yeah, so you multiply times the kilograms. Awesome. And now, what is the next step?
Add ending inventory.
Yeah, perfect. So the ending inventory, it says that it's the 30% of the following month's production needs. This was I always mistake it with this number. I always use this one, but it's this one because we're doing direct materials now. That's why we always multiply times the kilograms first. So that times 30%. Okay. And then we could even do it up to here because they're asking for the desired ending inventory of September. So this is it. But in the options, they give you a dollar amount. So if they do that, you just get the kilograms and then you times it by the dollar. So it's $4 per kilogram. So this is the answer.
I'm sorry, so for the add ending inventory, you multiplied which one times the 30%?
Just the next month, but the next month kilograms that you need for those cells times the 30%.
Thank you.
Yeah, I would do the whole budget, but we're only in question 7, so. Okay, let's do this one. So mostly when these variance questions, they give you a whole table of this is all standard and this is all actual numbers. So just like be careful not to mix them. And every time they give you this, just cancel it. Original budgeted output, you don't need that. You only need the actual output. Okay, so they're asking for the labor efficiency variance for December. Which one is the labor efficiency?
That's gonna be, you're gonna look at your actual hours. Right?
Mm-hmm.
And times the standard rate minus the standard hours times the standard rate.
Yeah, so I think it's column 2 and 3, right? So actual hours, standard rate times the standard hours, standard rate. Yeah, because in these two, you're seeing at the difference of the hours. So this is the efficiency variance. So the actual hours, what is it?
3160.
Yeah, perfect. Oh. Okay, the standard hours, they give it to you.
You take your actual output times your standard hours. So
Yeah,
your 4,200 is your actual output and your standard hours is your 0.7.
that's perfect. So 0.7 times 4,200 units. Oh my goodness.
That's 2940.
Okay, thank you. And then the standard rate.
So standard price. So standard rate,
$20.
$20 per hour.
Yeah, so we're just looking at direct labor. So
Mhm.
okay, so now we have to multiply these two. So 3160 is 20, 63,200.
And this one's 58,800.
Perfect. Okay, so the difference of these two. It's 4,400. And how do we know if it's variable, I mean, favorable or unfavorable?
So you had budgeted less than you actually spent, so it would be unfavorable.
Mm-hmm, yeah. And then, yeah, you can also see with the standard hour, actual hour. So the actual hour was 33,160 and the standard was 2,940. So they use more hours than what they should have. So that's unfavorable. Okay. So it's already 10:30. If you guys have to leave, that's fine. But if you want to stay, we can go through the last questions.
If you still have time, I'm
Yeah.
good.
Yeah, I can go through at least not the ratios because those take a long time, but at least the last three questions.
Thank you. Yes.
Sure. This one, I'm pretty sure it was in my final exam when I took the class. And I told you that this was also the hardest question for the exam 3. So yeah, but it would be like the longest question that they would ask you in the final exam. Most of them are like this, they're not super long. So this one, they give you a bunch of information like for the budgets and the balance sheet of October 31st, but they're asking for the retained earnings at the end of December. And because the balance sheet is October, we need to do November and December. And the reason that we do this is because they're asking for retained earnings. So retained earnings is the retained earnings that you have beginning plus the net operating income. So net operating income of November and December. So we're gonna do like an income statement for those 2 months. So sales in November is the first paragraph, so 380,000. And then 390,000 for December. Okay, so when they say collections are expected to be 70%, this is not important for the income statement. It's only for like the collections budget, except when it's there and when there's an uncollectible, and that's called bad debt. Oh, but first we're gonna find cost of goods sold. Cost of goods sold, 65% of sales. So now we can find the gross margin. Okay, now we can move to the expenses. So bad debt is the 3% of sales. Let's see what the company decides to have an ending merchandise inventory equal to 80% of the following month cost of goods sold. This is also important for like the, I think this is like direct materials budget or like one of the budgets, but not that income statement. So this is not important.
Where did the bad debt come from?
This 3%
Oh,
uncollectible.
Yep, sure, okay.
Sorry, can you click on the cogs real quick?
On the what?
Oh, you just did 65% of sales. Never mind. Sorry.
Yeah.
I got it.
Okay. So the other monthly expenses, that is important. So it's 22,000 for both because it's a fixed expense. And depreciation too. Depreciation goes in the income statement, 20,000. So now we can find net operating income by getting the gross margin minus the debt, other expenses, and depreciation. Okay, so retained earnings in the beginning was 259,600. So we just need to add these two to the retained earnings.
What did you put for the net operating income? How did you calculate that one?
Is the gross margin minus these three expenses.
Okay,
So this is the answer, 422,000. Because it's just, yeah, so you just add the net operating income. You will subtract dividends too, but they don't say anything about dividends, so that's it. Now
Wait,
question.
Natalia, can you go back to that one, please? How do you get that 422 again?
You add the retained earnings from October.
Uh-huh.
So retained earnings is beginning retained earnings plus net operating income and also minus dividends. But because we don't have dividends, we don't subtract it. And we had to add it to net operating income because they're asking for December.
Okay, so you're adding both those net operating incomes together and then also adding that retained earnings, and that gives you that 422.
Yeah.
Okay, thank you.
Okay, question 10. James just received an 8,000 inheritance check from the state of his deceased rich uncle. James wants to set aside enough money to pay for a trip in 5 years. If the trip is expected to cost 5,000, how much of the 8,000 must James deposit now if the rate of return is 12% per year in order to have 5,000 in 5 years? So like how much does he have to save on a bank right now to get interest of 12% to get 5,000 at the end of 5 years?
So I just do the future value equation in Excel, but for the amount that he must deposit now, I'll just plug in one of those answers till I get the ending answer of 5,000.
Yeah, so you can use the present value formula. Because the savings that he's gonna do is right now, so that'll be present value. And the future value is the 5,000 in 5 years.
So which one are you doing? Present value or future value?
Present value.
Either one works though, to be honest with you.
Oh, okay. Okay, so the rate is 12%. And then 5 years, there's no payment because he's just doing one saving like right now. So, but the future value is the $5,000 that he wants to have. And yeah, that's the answer. That's how much he needs to save right now. Okay, now the last question. The management of Kentel Corporation is considering a project that will require an initial investment of 47,000. No other cash outflow will be required. The president,
Natalia,
yeah.
really quick, on that one previous, is there a reason that it comes back different? I mean, because you got 2837, but the answer is 2835.
Yes, because all these Excel, like for exam 4 and for this final, they're doing the factor number instead of Excel.
Okay, so this question that you pulled is from like when they were using the present value tables, but we are using Excel. Okay,
Yeah, I should have
Okay.
said that too.
that makes sense. Okay,
Okay, so they're considering a project that would require an initial investment of 47,000. No other cash outflow will be required. And the present value of the cash flow will be 66,080. The profitability index of the project is closest to So who remembers the project profitability index formula?
It's your net present value divided by initial cash flow or initial investment.
Mm-hmm. Is it, but it is the present value of
Of the
cash.
cash flows.
Mhm. Initial investment. Okay, so we don't really have to do anything backwards on this one. It's pretty straightforward. So present value, they give it to you. So 66,080. And then divided by 47,000. So let's see. It's 1.41. I think in this Excel, it said that it was a 0.41, but that's wrong. Just know that it's 1.41. And yeah, then there's the ratios, but I think you can do them well. And there's the
Will they
answers
give us the
here.
ratios again?
What was that?
Will they give us the ratio?
Yeah,
sheet
maybe
again?
just like in the exam 4, the same ones.
Okay.
Mhm. So this is a good practice. You could like find every single ratio and then go to answers and just make sure that you did it right.
Yeah, I have a question.
Mhm.
In the net present value, when they give us like a financial statement that has contribution margin, it has net operating income, and they ask us to do like to give the net present value of the project. They also give depreciation, and in the one of the problems in the exam, they said only depreciation is not part of it. Does that mean even if we had the sales expenses and then contribution margin, which includes sales and expenses, do we still use the contribution margin number as a cash flow in our calculation?
So you're saying that they don't give you the net operating income or the
They
cash
give
flow, they give you.
they give everything. They
Okay.
they want to know the net present value. So I want to be sure about that, to know if we have to use the contribution margin as a cash flow and do it for all the years, just like we
Okay, I
do.
see. Yeah, you don't use the contribution, you use net operating income,
Mhm.
but then you add depreciation, and that's the cash flows. So it's like this, the circle that I showed right here. You always get cash flows from net operating income or net operating income from cash flow. So you would add depreciation and that will be the cash flow. And then you can do the table to find the net present value of the project.
Oh, so we don't need to do present value for sales, expenses, all these things. They're
No,
not part of
it's
it.
just there's like a question like the 12, I think. Well, kind of like this, like if they give you the income statement and
Yeah.
you have net operating income, so
Mhm.
you add depreciation and that will be your cash flow. So you can use this table and that will be the cash flow, and then you do the initial investment here. And then just find present value how you normally do it, but
Mhm.
don't do it like from the income statement. The income statement is just, it just helps you to give you a net operating income and depreciation. That's it.
So we just take the net operating income. Before we do the net present value for the operating income,
Yeah,
we
yeah,
subtract
because you need to,
it. We add it to it to get the cash flow.
mhm. Yeah, you have to do that first because you need to find cash flow first to find these present values.
Oh, all right. So we take the cash flow and we do the present value with the cash flow after subtracting the depreciation from net operating income.
Yeah, well, you add it. So if you have net operating income, you add.
Yeah, add it. Yeah.
Mhm. Yeah, but yeah, that's right.
Okay, thanks.
I had a question.
Yeah, you're right.
For number 7, I think I missed this step.
Here.
Yes. So how did you get the 44,000? You
Okay, so this is the partial budget. So we did for the ending inventory, which is the next month, October, times the 30%. And then you multiply this times the $4 because it says the cost of Jerusalem is $4 per kilogram. So we multiply that times 4. You normally multiply the dollar in the end of the budget, but just because these answers give you a dollar amount, that's why we did it like that.
Could you go back to that? I'm so sorry. The 44. Yeah. So you did that times 4 because of the $4, correct? You said.
Per kilogram, yeah.
Okay. Thank you.
Mhm.
I have a question, Natalia.
Yeah.
For the last question, yes, not for the other word, 12. In the last week, I tried to calculate return on total asset, and I can the same answer like the official answers. Can you calculate for this time? The third one, return on total asset. Yes.
Okay. So I don't know the ratios. Let's see. Return on total assets.
Net operating income minus or plus.
Oh yeah, the interest expense times 1.
1 minus the
That's right.
tax rate
Yeah, it's a good one.
divided by the average assets.
Total assets. Okay, so I think the easiest way would be like doing it by sections. So the deepest parenthesis is 1 minus tax rate.
Mhm.
So let's see the tax.
It's 30%.
Okay, yeah, 30%. So 1 minus 30%. So we have 70%. Then you multiply that times the interest expense. And the interest expense is the 49.
47 or 49,000.
So 49,000 times 70%. Okay, 34,300. And now we add the net income. So 160,000 plus this. Okay, so this is the numerator of the equation. Now we need to find the average. And that's the total assets. Yeah, total assets average. Right here. So the 1,579 plus 1,000.
Except this is 1,579,000.
Oh, that's, yeah, thank you.
Need 3 zeros on both.
I think that's why I'm missing this, because I actually noticed that I was putting the actual numbers that they listed and I forgot to add, like, if it's thousands or millions.
Well, and
Yeah.
that was one note that I was gonna say is especially because they give on the income statement and the balance sheet, they give it in thousands. So you have to add 3 zeros, but the dividends and the stocks, they don't change anything. So if you're doing your, like, those don't adjust. So if you do your EPS and all of those with those numbers, all of those numbers are going to be wrong. So you
Yeah.
have to make sure you add your 3 zeros to everything from the income statement and the balance sheet. Because if you don't, every number is going to be wrong.
Yeah. So like with most ratios, you don't really have to add the 3 zeros because everything is like from the income statement and balance sheet. But I would just do it just to make sure and to remember it, just like Katie said.
I don't think I realized that I needed to do that. I'm pretty sure I got that wrong.
Yeah,
But
only,
even
like,
in the exam, I
Yeah.
felt like in the exam when they didn't give you all the information and you had to like
oh yeah,
go and find like the assets minus liabilities and stockholders, like all of that. I feel like that threw me off quite a lot too.
yeah,
So we're supposed to add zeros to those as well, assets minus liabilities.
It was in the exam. It was one of the questions that
like
it just wasn't as straightforward as I was expecting it to be. And so
Yeah.
I think it
agree.
just threw me off.
I didn't, yeah, that's what I did. I just did I remember it, that question in the exam, but I just did the numbers that they gave me. I didn't add a bunch of zeros at the end. I didn't pay
I
attention
didn't
to
either.
that. Yeah.
But
Yeah.
in the quiz, I didn't add them. And I think that threw me off.
but most of the time if you don't add the zeros, it's okay. It's only if when you have to, like as Annie said, like if you need to find information or if you're using the 60,000 with one of these numbers without the 3 zeros, that's when.
It's not consistent. That's what Katie was saying. It's
Yeah.
not consistent.
Okay, so the average is this, and this is what we got as the numerator. So we need to divide these two. So the ratio is 0.12. Let's see. Yeah, 12.34%. You can put as a percentage.
Thank you.
Okay. All right. Well, I think that's it. This time I'm going to post the recording as like really soon.
Yeah.
Okay, guys. Well, thank you
Thank
so
you
much.
so much, Natalia. Thank you. Appreciate
Okay.
it.
Have a good one and good luck with this exam. The last one.
Good luck, everyone.
Thank you. You too.
Bye.
Bye.